piece of company which is valued at a higher price, but the actual buying may be done at a lower purchase cost. The fourth is directional, long-short equity strategy. If you think that the market is coming down, you could have shorted the market using futures, options, and so on. And of course, the final category would be others such as funds of hedge funds. You have got multiple strategy. You also have a multi-asset manager here. So the key is that we want to highlight to you there are few risks involved in hedge funds. Leverage, of course, it depends on how many times a fund borrows. Short selling is allowed. Of course, when you short sell and market moves up, then the fund makes losses. Appetite for risk, most of these can be deemed as high risk, but they are for sophisticated investors who understand the risk, who understand the strategies. And of course, they may be opaque because of lack of transparency and regulation. So the key question is that if there are so many risks involved, why are people still going to hedge funds? After all, it's a $4 trillion US dollar industry, maybe down to $2 trillion now. Now, if you look at the chart here, this is a composite of hedge funds done by HFRX Global. From the peak in January 2008 till the trough in Q4 last year, hedge funds in general, as a category, has fallen by 25%. But of course, in Q1 until today, they have gone up by 11%. Right? So the key is why and how. Now, to answer this question, if you look at the breakdown of different hedge funds and different strategies and compare it with equity indices, you will then see that in 2008, okay, as a composite, hedge funds declined by 20.7%. But if you compare the S&P 500, the index, the US stocks index, has come down by 38.5%. And if you look at emerging markets, well, it's nearly 50%. So are hedge funds worse off? It may be worse off if you have gone to convertible arbitrage strategy. But if you went into macro strategy, it's positive return, 5.2. Right? So the key is try not to lump hedge funds as a single asset class. Rather, break them down into different strategies. Let it be macro, event-driven, and so on. Find one that is appropriate for the investment team or the investment climate. Okay, then that's where the money is. So the point that I wish to highlight here is that there is always a place for hedge funds in this kind of market environment and going forward. Partly because interest rate will remain low for a prolonged period. There is huge amount of liquidity, meaning that funds or money will chase after returns. But of course, there will be some sort of restructuring. The shift will be to focus on lower leverage hedge funds. Okay, there will be incentives for hedge fund managers themselves to be more transparent, and also there will be dominance of hedge funds which go on a more global macro strategy. Remember the strategy that was adopted, which gave a positive return? These are the guys that could continue to outperform because they look at different markets, different economies, and they try using their strategies to extract values from market which you think are undervalued. So with this, I leave you with my presentation, and I'll pass you back to David. Thank you.
Thank you for that, Julian. I must say the hedge fund industry has yet to arrive in Malaysia. The Securities Commission in Malaysia is taking a very conservative approach, understandably so, because it is complex. If any of you have ever read an info memo document from any of the hedge funds, you won't understand it, trust me. It's worse than structured products. So I think we might have to wait a while, but certainly there's a place for hedge fund strategies. The other complexity, of course, is an obvious question would be, how do I know which hedge fund strategy to use under which market condition? So many private banks sell multi-strategy hedge funds, which eventually diversifies the risks, but of course diversify the returns too. Anyway, I'd like to hand it over to Pankaj, who I understand has 8 slides, which is great. If you could give a warm welcome to Pankaj. Thanks.
Thank you, David. Very good afternoon to all of you. First of all, thank you to the organizers for inviting me and sharing my thoughts. I actually have a very simple slides to present to you today. Of course, as you know, the title of this session is Beyond Market Volatility, Lessons Learned and Opportunities. So my typical way of doing things is that I always look at a title and see what can I present to the audience here. But as you can see, I think David started the ball rolling in terms of putting out a lot of questions in our mind, including to some of us who are the panelists. And I'm sure some of you too have more questions after Lauren and Julian has put out some slides. But before we answer some of those questions, I have a question for you. How many of you, and please put up your hand, understand what is volatility? Well, 25, 30%, all right? Perhaps more? More, okay, maybe 40%. But anyway, typical of, in today's environment, what we do is that we go to internet and find out what is volatility. My presentation outline will basically be on 4 things, which is very focused into the title of today's topic, Market Volatility Defined. Then I'll talk to you about some of the observation that we can see in practice. What do we see in US, as well as what we can learn and the opportunities in this environment. Well, according to Wikipedia, as you can read here, volatility most frequently refers to the standard deviation of the continuously compounded returns of a financial instrument with a specific time horizon. I'm not sure if any of you have actually looked at what is volatility defined as, but you can see here, it is often used to quantify the risk of the instrument over that time period. So obviously, volatility is something that measures changes in price levels of an index or a stock. And to basically explain more about how we can see volatility in practice, what I did is that I took the current levels. If you look at the index in terms of where markets are today, actually the levels I took was as of 30th September. As you can see, over the past 2 weeks itself, market has actually rallied even more. But what is interesting if you look at this slide is that you will note that markets have really experienced huge volatility over the past 21 months or so, from 2008, start of 2008, when the market peaked mostly, and we hit bottom somewhere in March of this year, and before markets recovered. And in the past 6 months itself, you can see on average, if you take the Asian markets, including that of the US, average markets have recovered 83% from the bottom. This is something that we have not seen in a very long time, especially, let's say, if you take a time horizon of the past 10 years or so. In Malaysia's case, if you look at it, even from the bottom, we are already up like 50%. And how many of us had the opportunity to really participate in this rally that we saw how the volatility, took precedence? My next slide, I will try to explain to you in terms of the index performance and how volatility is actually measured in the market. What I did is that I took the 30-day volatility of the KLCI between 3rd January of 2007 and 30th September of 2009. The 4 parallel arrows that you see on the slide is basically tells you that volatility typically increases when the market actually falls. All right? And in the past 33 months, we actually observed 4 different occasions where volatility actually spiked up quite strongly. In fact, the reading was more than 25. And you can see that there were 2 or 3 occasions where actually volatility peaked at about 30 to about 35 on the index, on the 30-day volatility index, where the market actually hit some temporary bottom. But what is more interesting when you look at this slide is that when the market tends to rally,